Washington is spending billions fighting Iran, and Russia is cashing in on every single barrel. Here's the number nobody is saying out loud. Before this war, Russia was selling oil at around $58 a barrel. The G7 price cap, the financial weapon the West designed specifically to bankrupt Moscow, was barely working, but it was working. Then, Hormuz closed. Brent is now $110. Even with a $30 discount, Russian crude is at $80 a barrel. That's 33% above the cap. The cap is not being enforced. It is mathematically broken. Russia's daily oil revenue has gone up an estimated 75 to 85%. Not because they're pumping more, because the price changed. Pre-war, 3.3 million barrels a day at $58. That's $191 million a day. April 2026, 3.8 million barrels at $90 to $95. That's $342 to $361 million a day. Russia made an extra $150 to $170 million every single day. From a war it didn't fight, and that's before China comes back. When it does, that number gets significantly larger. This is issue 6 of Crude Oil Desk. We track global oil flows and the geopolitics behind them. Last issue was about the United States, how the Hormuz crisis turned America into the swing supplier for the entire world. This issue is about the other winner, the quieter one, the one nobody wants to talk about. Let's start with what the export data actually shows, because the headline numbers are misleading. Total crude loading at Russian terminals surged to 5.5 million barrels a day in May. But about 1.9 million of that is Kazakhstani crude, Betafan CPC blend, KEBCO, transiting through Novorossiysk. That is not Russian oil. Strip it out, and Russian-only seaborne exports look like this: 3.3 pre-war, 3.5 in March, 3.8 in April, back to 3.5 in May. That's a 13% volume increase at peak. Not dramatic. The revenue story is entirely in the price. India just replaced its entire Middle East oil supply in 8 weeks, and Russia filled every single barrel of the gap. Before this war, Iraq was India's third largest oil supplier, 993,000 barrels a day. When Hormuz closed, that collapsed to near zero in a single month. Russia stepped in. India's Russian imports went from 1.1 million barrels a day to over 2 million. Russia's share of India's total crude imports went from 21% to 46%. For the first time ever, India is more dependent on Russia for oil than on any Middle Eastern country. This didn't happen because of a political decision. India didn't choose Russia over the West. India chose the barrel that was physically available. The logistics are now established. The refineries are configured. The pricing is understood. When this crisis ends, India faces a commercial choice. Go back to expensive Middle East crude, or keep buying Russian oil at a discount worth $1.6 billion a year per dollar of discount. The commercial logic writes itself. There's a footnote in the data worth noting. Iran appeared in India's April import figures at 133,000 barrels a day. India is buying every discounted barrel it can physically reach, regardless of origin. That tells you everything about how buyers are behaving right now. Price and availability are the only variables that matter. The sanctions implication here is significant. India never formally endorsed the G7 price cap. It never agreed to limit Russian purchases. And now, with Russia supplying 46% of India's crude, the entire architecture of Western sanctions policy on Russian oil looks different. You cannot enforce a price cap on a buyer who never agreed to it, buying volumes that have doubled since the cap was designed. The structural shift happened in 8 weeks. The commercial infrastructure to maintain it, the shipping routes, the refinery configurations, the pricing agreements, those don't disappear when Hormuz reopens. The G7 spent 3 years building a financial weapon to bankrupt Russia. It just became irrelevant because of a war in the Middle East. The G7 price cap set a $60 ceiling on Russian crude. The logic was elegant. Keep Russian oil in the market, don't create a supply shock. But cap the revenue, so Moscow can't fund its war machine. At $73, Brent with a $15 Urals discount, Russian crude was sitting right at $58. The cap was barely working, but it was working. Brent is now $110. Even with a $30 discount, wider than anything sustained since 2022, Russian crude is at $80. To enforce the $60 cap at $110 Brent, you'd need to impose a $50 discount. No buyer accepts that. India doesn't. China doesn't. Turkey doesn't. They buy at market. The cap hasn't been formally abandoned. It still exists on paper. But the war Washington is fighting against Iran has made the financial instrument it designed to constrain Russia functionally irrelevant. That's not a political critique. It's arithmetic. China cut Russian oil imports by 41% since this war started. Everyone is reading that as China distancing itself from Russia. They're wrong. Here's what actually happened. In the second half of 2025, with Brent at $73 and Russian Urals just below the price cap at around $58, China did something very deliberate. It loaded up. October, 1.3 million barrels a day from Russia. November, 1.65 million. December, 2.09 million. That December Urals figure alone was 5 times the 2024 monthly average. China was pre-buying cheap Russian crude at the exact moment it was most affordable. Then Hormuz closed. China has 1.4 billion barrels in strategic reserve. It switched to drawdown mode and cut all seaborne imports. The grade it cut first was Urals, the longest haul, 30-plus days from the Baltic. The most expensive marginal barrel. Basic logistics economics. This is not a political signal. The relationship between China and Russia is intact. The infrastructure is in place. The pricing agreement is understood by both sides. When China restocks, and it will, when prices soften, Russian Urals will be the first call. It is the cheapest available heavy crude with no political complications from Beijing's perspective. There's a third winner in this story that's getting almost no coverage. Kazakhstan. CPC Kazakhstan exports to Europe surged 79% from January to May, from 764,000 barrels a day to 1.36 million. European refiners are legally importing more Kazakh crude than ever before. It loads at Novorossiysk alongside Russian crude, but it is explicitly exempt from EU sanctions. It is not Russian oil. Actual Russian Urals to Europe is declining, down 67% over the same period. EU sanctions enforcement, however imperfect, is working on that specific margin. What looks like Russia flooding Europe with crude is mostly Kazakhstan. The Tengiz Future Growth project, backed by Chevron and ExxonMobil, is delivering its additional capacity at exactly the moment European demand for non-Hormuz crude is highest. 4 things to watch before the next issue. First, India's Russian import share. If it holds above 40% after the crisis ends, that is a permanent restructuring, not a temporary substitution. Watch Indian customs data and statements from Indian Oil and Bharat Petroleum. Second, the G7 price cap. Watch the next energy ministers meeting for any signal on formal revision or quiet abandonment. The most likely outcome is continued formal maintenance with acknowledged non-enforcement, but any explicit revision would be a significant geopolitical signal. Third, ESPO flows to China. When ESPO stabilizes and stops declining, China's drawdown phase is nearing its end. When Urals reappears in China-bound flow data, even at modest volumes, the restocking cycle has begun. That is the moment Russia's revenue outlook inflects sharply higher. Fourth, Kazakhstan, CPC long-term contracts. Watch for European refiners locking in multi-year supply agreements. That would structurally cement the Novorossiysk corridor, regardless of what happens politically in Russia. This is Crude Oil Desk. The oil market moves before the headlines do. If you want the full analysis every week, vessel tracking data, flow breakdowns, the numbers behind the numbers. The newsletter is free at crudeoildesk.com. Link in the description. Subscribe and hit the bell so you don't miss our weekly insights. See you next week.